Hi everybody, this is Alan at Alan Talks FinTech, and today we're going to talk about the S&P 500 index. The S&P 500 index is a market capitalization weighted index currently consisting of about 505 large cap stocks. We'll take a look at them here in a second. The largest ones in the list are Apple, Microsoft, Amazon, and then the rest are kind of a little bit less size than those. And we'll take a look at their returns. We'll do some little calculations. Take a look at what you should do with some of the knowledge from learning about the S&P 500 index. So let's take a quick look at this article from Investopedia on the Standard & Poor's index. As you'll notice, it's a market capitalization weighted index, meaning the composition of the index is based on the total capitalization of all of the stocks in the index, and then each stock, its particular capitalization determines the weighting compared to overall rest of the companies combined. So one thing about this index is that if you're a bigger company, you'll have a larger percentage of allocation in the index. So a lot of the top 10 companies or even the top 20 make a larger portion of the index than rest of the companies that have a smaller capitalization. That has some effect in that these companies, say like Microsoft or Apple or Amazon, they get a larger percentage within the index, so there's a lot more money kind of going into those companies. You look at composition of a lot of large cap mutual funds, you'll also find that the same companies are in there. So it's very common to see Microsoft, Apple, Amazon, and companies like that as part of large cap mutual funds. So in a way, the S&P 500 index is very similar to large cap mutual funds. The composition of the S&P 500 is determined by a committee rather than a formula with the Russell indexes. There are other S&P indexes. There's a mid-cap 400 and a small-cap 600. And actually the S&P 600 that actually probably does better than the S&P 500 in terms of average gain over a long period of time. One of the symbols that a lot of people will follow is SPY, and that's reflective of the S&P 500 index on the stock markets. So let's take a look at the companies in the S&P 500. So we're going to go to Slick Charts and look up their list of the companies in the S&P 500. So let's first kind of scroll down through the list. You'll see at the very bottom that there's 505 companies in the index. So you notice at the very bottom, the composition or the percentage allocation in the index of these companies are pretty small. So the ones at the bottom don't make up a large percentage of the index compared to the ones at the top. So let's take a look at some of the companies at the top of the list that make up the greatest weight. So this recording is of May 5th, 2019. And you'll see Microsoft actually has the largest percentage by weight right now in the index. And you'll see Apple and Amazon are fairly close. Apple, not too long ago, went over the $1 trillion mark briefly, and Microsoft has kind of been around that mark. So those two are the largest companies, followed by Amazon. And like I said, if you go look at large cap mutual funds, you'll find these three companies in a lot of those mutual funds. Now you'll notice Facebook, Berkshire Hathaway, JP Morgan Chase, Johnson Johnson, the two Google stocks, ExxonMobil all make up the top 10. And that's pretty common what you'll find in large cap stocks. And since the S&P 500 is a large cap index, you'll see a lot of the same companies across the board. So a lot of money goes into these companies. They actually drive the stock market quite a bit, which is good and it's bad. So if those companies go down and people start selling off, then it affects an index like this quite a bit. So you see further down the list, Visa, Bank of America, Procter & Gamble, Cisco, Disney, Verizon, Pfizer, Intel, Home Depot, MasterCard, and then AT&T. So a lot of these companies are very well known. See PayPal, IBM. Just a quick look. All right, the little chart down on the right comes from macrotrends.net, and it shows the gains of the S&P 500 since 1928. Let's go look at some of these gains both on the website and in a spreadsheet and talk a little bit about them. So this is the chart from macrotrends.net, and it's a really interesting chart that you can look at and see the rate of return over various years. Now, what you can do is you can slide this little slider on the left. You can pick your starting year. So you want to pick 1980, and then you can pick the ending year. So you want to pick a different ending year than today, and then you can hover over these amounts and it'll tell you the return on those particular years. So you notice in 2008 minus 38.49%, 2019 so far 17.5, and you can kind of go through all the years. So the other thing you can do is you can download the data from these years and then take a look at them. So we'll do that. We'll go jump over to a spreadsheet and take a look. So I downloaded the data from macrotrends.net. It downloads as a CSV file, and so I opened it in the Excel spreadsheet and started playing around with it. First thing I did was I kind of picked ranges of 10 being the percentage of gain. So starting from less than 30% gain, minus 30% to minus 20%, minus 20 to minus 10, minus 10 to 0, 0 to positive 10, 10 to 20, 20 to 30, and then over 30%. And then basically kind of counted up those particular years on what percentage they gained in those particular years. And then what you kind of find is that there were only 3 years that gained or lost less than 30%. So about 3% of the years. Altogether, there were 92 years in this range of data. So only 3 of them were less than 30% loss. Another 3 were between 30% and minus 30% and minus 20%. 13 from minus 20 to minus 10, 10 from minus 10 to 0, only 16 from 0 to 10, 23 from 10 to 30, 15 from 20 to 30, and then 9 over 30%. We broke them down by year. And then you see the percentages, 3%, 3%, 14% for minus 20 to minus 10, 10% from minus 10 to 0, 17% from 0 to 10, 25% from 10 to 20, 16 from 20 to 30, and so forth, 9.78 for over 30. So when you take a look at it, the gaining years, there's 68% of the years that are gaining years, and there are 31% that are losing years out of all those years. And then if you graph it as a chart, you'll see in this chart down here that the majority of the years are gaining years. So if you invest in a S&P 500 index over a long period of time, 68% of the time you're going to be gaining. That's why most people suggest that you invest in an S&P 500 index fund, because majority of the time you will gain. And then what you'll see is that actually you'll gain 10 to 20% most of the time, because that will have the highest number of occurrences. So it's more weighted towards the positive side than it is the negative side. All right, back to the slide deck. So you notice from the spreadsheet that only 16 times out of the 92 years were we actually in the 0 to 10% range. So what you'll hear a lot is the average return on the S&P 500 is about 7%, between 7 and 8% over the 92 years in which it existed. And if you average up each year in that spreadsheet, it comes out to 7.5. Now, here's the thing, is only a small percentage of the time, there's around 17%, that you're actually in that range. Most of the time, you're either in the 10 to 20, 20 to 30, or less. So you're not going to find too many times where you actually get 7% return. You'll actually get more. Sometimes you'll get in that range or a little bit less, or lose. But vast majority of the time, it's going to be positive. And then it's, you notice from the macro trends chart over here on the right that there's a lot more green than red. So the big takeaway from this is you got to kind of stay in it for the long term. If you're going to invest in S&P 500, you got to really stick with it. You got to stay with it 15, 20, 30 years, and you'll do well over those years. And we'll take a look at a use case from one of my 401ks. All right, let's take a look at one of my 401ks. I used to work for IBM, and I left IBM at the end of 2003. And so I kept my 401k money at IBM, and so there's no new money going into that 401k. It's just whatever I've reinvested and what funds I've had it in. After I left in January 1 of 2004, there was $153,000 in that 401k. I don't really remember what I had it invested in way back then. Did I have it in cash? Did I have it in mutual funds or what? As of August 8th, 2018, when I produced this slide, that fund had risen to $312,000. And I thought, wow, I'm doing pretty good. So that was 14 years since I had left IBM. And if you look at the gain, well, I only gained a little over 100%. It was only 4.9% per year. So I said, what if I go back and I take a look at what if I had invested that money in a S&P index fund? I decided, well, let's take a look. Would have I gained if I'd left it in an S&P index fund over all those years? Well, come to find out, I would have ended up with $495,000 if I just left it. And that's including going through the 2008 crash. If I just left it through that entire time, and I would have gained over 200% at about an 8% rate. I didn't do very good because I moved stuff around. And one thing I did was, when it got close to 2008 crash, I'm like, stock market's pretty high. I'm going to move my money out and move it into cash. So I moved it into cash just before the crash, and so I didn't lose any money. But the problem was, as you're coming out of that crash, you're like, oh, it's going to go back down again, and you're worried about putting money back into the market because you're worried about it going back down. And so it took quite a while before I put money back into the market. Took it out of cash and put it in mutual funds or some sort of index fund. So it didn't really gain, and I didn't really pay attention to it until, quite a few years later, and then I started putting it back in mutual funds. So that's why I missed the gain, because I just didn't leave it like I should have. Now I know. So let's take a look at this little online calculator that would show me how much I would have gained. And then you can kind of do the same thing if you've had money for a while that's kind of sitting there untouched and you're just reinvesting it. Okay, here's an online calculator of the S&P 500 from DQY So if I enter my amount in there, 153,573.86, pick starting month of January 2004, and this recording is of May 2019, with 0%, zero monthly investment, and I click the calculator. What would I have? Well, if I left it in there and reinvested, I'd be at $500,000. And right now, as of today, I think I'm at $302,000. So I basically have lost about $200,000 by not just leaving it in an index fund, S&P index fund, and just leaving it over all those years. And see, I would have gained about 8%. You can play around with this calculator and see how you would have done. It does make a difference what year you start with. So suppose I go back to year 2000, because there are a couple three bad years in a row, and then I click calculate. See, I'd have a lot less money, $413,000. So the starting year does and month does make a difference whether they were down years or up years. So if I starting at 2004, it was right after three bad years, and then we only had the 2008 really bad year after that, and everything else was mostly positive, and so it would have gone up to 500,000. So one thing to learn from this is that you should really leave your money in the S&P 500 index and just don't touch it, basically, if that's where you're going to invest. I also want to show you this DQY website. Also has another form of calculator for the S&P 500 if the dividends are reinvested. So you can pick a particular year. So let's suppose I go back to January 2004, and then this is May of 2019, and I just click calculate. So it'll show you over that period of time that the return is 160%, but if you reinvest, it'll take you up to 250%, and then you'll get an 8.5% yearly return over that period of time. So reinvesting your dividends is really important. That shows you the additional power, 6.4 versus 8.5. So important lesson learned from that. But you can play around with this calculator too and see what you can get. Like suppose I go back to 2000, you'll see it changes. The annualized return is 5.7. So those three bad years, starting with year 2000, you can see what impact that has on the rate of return. If I pick a year like say 1980, hit calculate, see it's a lot different, 11.5, because if you look at the graph from 1980, it's mainly green years all the way, and then you only had a couple bad years in there, so you had more gains over that longer period of time. So this is a slide kind of depicting what I was just saying, that when I originally did the prior slide, I said my starting year was 2004 because that was the first year of no new money coming into that 401k fund that I had. I could have got 8% all the way up through 2019, but if you pick a different starting year like 2000, and you can see in the chart, 2000, 2001, 2002 were three bad years in a row, and then you hit 2008. So if you'd started in 2000, you'd only get 5.3% rate of return over those years. if you started in 1980, you get over 11%, because you can see there's a lot more green years. So I just want to show you that, and something to be aware of. So I think the longer period of time that you have to invest, you generally will have a lot more green years than red years. All right, so a lot of people recommend that you just put your money in the S&P 500 index and just kind of let it go. And you should average in the 5% range, the average being around 7. So a couple things to pay attention to. Any fees in your portfolio. If you invest with Vanguard, or I think Fidelity has some S&P type index funds, you want to look at the fee structure and make sure it's a very low fee so that it doesn't reduce your portfolio gains over a long period of time. The other thing is you want to kind of avoid some of the mutual funds. There's a lot of them that are managed that don't necessarily follow the S&P 500 index, and they generally have a lower rate of return than the S&P 500. In fact, Warren Buffett one time bet some hedge fund managers that they couldn't beat the S&P 500, and he won that bet. Now, there are some downsides. So index funds have a large portion of the money in the stock market, and there's some articles and videos that I'll link in the description that you can read, that if the market does go into correction and people start pulling their money out of S&P 500 index, that it could turn into kind of a little bit of a vicious cycle. People taking money out, index going down, scaring people, they take the money out, index goes down, that scares people, they take their money out, and there's kind of a cycle that could occur due to that. And then the other downside is the stocks that are in the S&P 500 tend to do better because of the index, and the stocks that aren't in the index tend to do a little bit worse because there's not as much money going into those stocks. So some people say, well, there's not as much value investing occurring because of the indexes. People aren't looking at the values of the companies. They're just looking to see whether it's in the S&P 500 or not. This is a little chart that you'll find out on the internet in various forums. This one come from Nationwide Financial, that showed the different sectors per year and their percent gain or their percent loss. And you'll notice the S&P 500, which is in white, has been pretty much kind of in the middle range most of the years compared to the other sectors. If you look at 2018, S&P 500 is down 6%. Healthcare was up 5%, where energy was down 20%. Other years, technology does really well. 2009 it was up 60%. Other years, not so much. The next year it was up 9%. And same thing with the other things. Money tends to go to utilities in years where there's kind of a pullback a little bit. So utilities will be up, like last year, 2018, there was kind of a pullback, so some money went into utilities. When things are growing, the technology area tends to go up. As you'll see, the S&P 500 is kind of in the middle of the pack. If this video helped you, please click subscribe, click like, enter your comments. Until next time, we'll see you again, and we'll talk about a similar type of topic.